Welcome to our macroeconomic session of our Kroll Alternative Investments Conference today. Joined by Janet Henry and Megan Greene. We've had a bit of technical difficulties and we've lost Megan for a moment, so we're going to switch up our order. We were going to start with a U.S. perspective, but we'll go to the global perspective. And so Janet, why don't you kick us off?
Okay, thank you very much, David, and hello, everyone. So yes, the intention was that Megan would kick off with the US outlook, and then I would talk a little bit about the global overlay, focusing a bit more on the other countries in the world. So I'm actually going to flick through some slides, which are Megan's slides, while she tries to rejoin, having been kicked out by her internet, and turn to my presentation, which is called Reining It In. And that is, of course, a reference to the fact that central banks around the world are now starting to rein in the ultra-loose monetary conditions around the world. And I want to start off with a snapshot of our global GDP forecasts, not the point estimates, but the shape of the recovery that has already happened and that we are projecting until the end of 2022. And the point is to show you how the shape of it now looks relative to how we viewed the world before the pandemic actually began. And looking at global GDP on the left-hand side, you can see that by the end of 2022, we now expect the level of GDP to be back where we were projecting it to be before the pandemic even began. And focusing on the advanced economies, mainly the US and Europe, we are now projecting the level of GDP by the end of next year to be even higher than where we were projecting it to be before the pandemic actually began. And that is, of course, partly a function of dramatic medical developments on the vaccine front, but also the enormous scale of monetary and fiscal stimulus that has been delivered. But it would be premature to say there's been no lasting damage to the global economic outlook from the pandemic itself. This doesn't tell us about scarring. It doesn't tell us how much debt has been accumulated. It doesn't tell us about the distribution of the gains, whether it's to the corporate sector or indeed the household sector. So there's still quite a lot that needs to be considered. But before we think about some of the longer term issues, which I think we'll turn to in the Q&A, let's look at the picture we have currently, which is that based on where we are at the end of the third quarter of 2021, the picture is very, very clear. Global GDP has been slowing down. Global inflation has been accelerating, and it's been accelerating by more than had been expected, both at the headline measure and the core inflation measure. Now, focusing on the growth outlook, partly the reasons for the slowdown are in places the fact that the battle against COVID-19 is still not over. Different countries are responding differently, but in at least a handful of countries around the world, they are still at their peak number of cases. Different countries are responding in terms of restrictions, others are living with it. And that is one of the factors that has led to some dispersion in terms of the growth developments in various economies around the world. On the left-hand side, you've got the likes of the US, the Eurozone, the UK, economies that all reached reasonably high vaccination levels of around 70% or so, and have continued the reopening, even with still quite a high level of cases. On the far right-hand side, you've got the Asia-Pacific economies, those economies that for a long time have been pursuing very much an elimination strategy, shutting down their borders, shutting down their economies. And in some of those countries like Australia and New Zealand, they had a deeper contraction in GDP in the third quarter of 2021 than they did in the second quarter of 2020. And then in the middle, you've got some emerging economies like India and Brazil that really didn't close down their economies. And then, of course, you have got China. China, there was little or no growth at all in the third quarter of the year as the restrictions took place. We have been looking for a stronger pickup in GDP in the final quarter of 2021. We've had to scale that back partly because of the ongoing impact of COVID and parts of the economy still being subject to restrictions, and partly because of a deeper than expected slowdown in the property sector, which the government has been reining in for some time. But of course, we've had a degree of bankruptcies coming through in the property sector that will still be playing out through the course of 2022. Now, when we think about it's not just that, I suppose, that the COVID-related developments and the restrictions that have been in place. For most countries, we do look for a gradual reopening to continue. We do not look for a complete reversal through the course of 2022. But we've also had differing degrees of a mix of growth. In the advanced economies and some commodity producers, it's been very much a consumer-led recovery. Across Asia, it's been much more of an industrial and an export-led recovery. Now, remember, this consumer goods recovery, as we all know, has been much more driven by goods than services. Consumers have been very much supported by a large degree of government handouts, job support schemes, and indeed various schemes to keep companies alive. But how this has fed through in the global industrial cycle is very clear. On the right-hand side, you've got global industrial growth. On the left-hand side, you've got world trade in goods, both in level terms and in growth rates. Now, we know everything at the moment with growth rates because it's measured against implosion in 2020. All the growth rates in year-on-year terms look very, very strong. But if you focus on that black line and indeed the industrial chart on the right-hand side, that is in level terms. So these parts of the economy have already more than recovered pre-pandemic levels. They are in places above their pre-pandemic trajectory. But this is going to start to evolve. Already the industrial cycle seems to have seen the best of the upturn. It will probably moderate only gradually, not least because of some of the supply disruptions that we still keep hearing so much about. And this partly reflects the beginning of this rotation of spending from goods to services. It's just that this rotation is being emphasised by some of these supply shortages. In fact, this is just a chart of the US. I use the US not because I want to focus on the US, Megan's going to do that, but it's to make the point that we can get a nice disaggregation of spending. We can see what happened looking at the red columns in the year from February 2020 to February 2021. We can then see what's happened as the broad economy has continued to open up, this shift towards related spending coming through on clothing because people are going out, but also a growing range of services. But services spending in virtually every country is still way below pre-pandemic levels, even though goods-related spending is significantly higher than that kind of area. And you can see this also, the supply element is exaggerating it. And that's why I'm showing you this chart on the left-hand side, because this is the US retail sales picture. The red line is retail sales excluding motor vehicles, and it's actually been quite stable in recent months. The sharp slowdown has been in motor vehicles and part dealers. It's fallen back very, very sharply. Now, this is the US, but it's been a global story. The fact is we've even had a situation in the UK in the third quarter where the price of used cars was higher than the new equivalents. You just can't buy the new equivalents at the moment because there is such a severe supply-related shortage. And that's going to continue to play havoc with some of the data, which will still likely be quite volatile. It will still mean that as the industrial cycle rolls over, it might be somewhat uneven, and it might be a more elongated moderation in that growth rate on the industrial side. Also, there is a certain amount of misinformation globally about supply chains and disruptions related to COVID. We keep hearing stories about supply disruptions because of COVID in parts of Asia, but actually our perception from our economists in the region is that the supply disruption has been nowhere near as severe as has been reported. We've seen that in the Chinese export data. We've even seen it in some Asian industrial data. The challenges are logistical. A lot of them relate to shipping. And actually, even when you look at something like the purchasing managers' surveys, look at delivery times on the right-hand side, you can see that the delivery problems in Asia are much less severe than they are in the advanced economies. And this is, of course, what's contributing to that desire for some companies, widely reported, the likes of Amazon, that are now buying new containers and actually getting those to Asia to ship the goods rather than waiting for the existing containers to be shipped back from Long Beach through to Asia. And also there is evidence that these disruptions, which are obviously feeding through into the price increases, are impacting on consumer confidence and consumer behaviour. Megan and I are going to have a more detailed discussion about inflation. I don't want to dwell too much on inflation other than to make the point that the rise in prices is impacting on consumer behaviour. And that's what this chart is just showing you. It's the University of Michigan survey from the US asking people, is this a good time to make major purchases of household goods? You can see, looking at the left-hand side, that actually consumers think that it's about as bad as it was at the onset of the pandemic, and it's about as bad as it was at the beginning of the global financial crisis. But it's not because they can't afford it, it is because prices are so high. If you look at that right-hand chart, which asks people, why is it a bad time to make a major purchase, you can see that actually that pricing element, that black line, is now at its highest level since the late 1970s. It's not about affordability as it was in 2008. So I'll just finish with a couple of points on inflation, and then hopefully Megan will have rejoined us. It is just a snapshot. This inflation story that we will discuss has been across the board. This is a chart of the latest inflation releases in all of these different countries relative to central bank inflation objectives, which are the black candles for the range, or indeed the lines. But there is some geographical divergence. It's interesting on the left-hand side, it's mainly the emerging economies that have seen the biggest increases in inflation, particularly countries with high inflation expectations like Brazil, and where food and energy make up a big share of the basket. Apart from the emerging economies, you've also got the US up there. On the right-hand side, the countries that have had the lowest inflation and are in places below central banks' objectives are actually in Asia. And part of that is explained by the differing mix of growth that I referred to earlier on. The fact that in Asia, it's not been a consumer-led recovery, it's been an export and industry-led recovery. Labour markets have not been supported. They haven't got the job shortages that we're suffering from in the West. They haven't had that really strong consumer demand. The consumer recovery in Asia, broadly speaking, has been a little bit weaker by Asian standards than expected. And you can see this in the policy framework. Again, Megan will talk about the policy setting for the US. Hopefully we'll talk about it more in our discussion. But just setting the scene on the emerging economies, this has really been the picture on core inflation. Latin America, CEMEA, much higher inflation than the likes of Asia, and much, much more aggressive in terms of interest rate rises. Individual meetings raising rates by 100 basis points or more. We saw that initially in Latin America. We've now seen it across CEMEA. We think those countries will have largely finished their tightening by the middle of next year. They couldn't afford any currency appreciation. Inflation was already too high. They had to be more aggressive on the tightening. In Asia, we do not expect the interest rate rises to begin until the second half of 2022. And certainly for the ECB and the Fed, for now, they're buying asset purchases. So I will leave you with the summary of my remarks, which is that we've seen a quick bounce back in growth. That should limit the scarring, but there's still going to be some lasting damage. There's still lots of uncertainties related to COVID. I haven't really got into the other areas and growth uncertainties. Perhaps we can discuss those in the Q&A. Lots of uncertainties regarding inflation, short-term developments, as well as medium-term challenges. And for central banks, aggressive moves now coming through from the emerging economies. But for the Fed and the ECB, asset purchases continuing at least through the first half of 2022 before we start to think about whether it's appropriate timing for the liftoff in rates. Now, I will flick back to the start of the US presentation and hope that Megan has been able to join us to take us through the US outlook.
Yeah, thank you so much, Janet, and apologies to everyone for my Wi-Fi going down, but I'm here now, and as Janet highlighted at the beginning of her presentation, I'm going to focus on the U.S. while she was going to focus on the rest of the world. And so I'll give an overview of the U.S., and then Janet and I will have a discussion about some of these themes that we'll have both brought up. I start every presentation at this point with an epidemiological slide, and have done since the beginning of the pandemic, because we can't know where the economy is going if we don't know where the virus is going. And this is actually a positive chart. It's just to show that the Delta variant, which had been so contagious and had created yet another wave of new cases, if not a wave of deaths, as we've seen before, it's finally receding. And that goes both for the U.S., but also you can see in the chart on the right, it also applies globally. So that's the good news, that the latest wave, as vaccination has been rolled out, seems to be abating now as we go into winter. So it doesn't necessarily mean that the worst is behind us. But for now, the Delta variant had really been impinging on demand and activity. And so that has waned. The bad news is that so has growth. So growth is also receding. And I think it's fair to say that we've had this, unbelievable contraction in the U.S. and across the globe. And then we've had this incredible kickback, and we're sort of in the long, hard slog part of the recovery now. So I would say that while growth might accelerate in the final quarter of this year, generally, I think peak growth is behind us in the U.S. and also other developed economies. So this is just a chart on the left showing the contribution to real U.S. GDP growth for the third quarter. And you can see that the biggest contributions were private consumption, which is red, and yet it's down really significantly from the first half of the year. And then also private inventories, so restocking, which is actually surprising that was such a big driver of growth given the supply chain disruptions that we've seen over the course of the past couple of months in particular. Now, if you look at the chart on the right, it explains why private consumption was down significantly to some degree, and it's because motor vehicles and parts, that contribution to GDP growth was down incredibly, and so that was a major drag on private consumption. I expect this to accelerate a bit next quarter, but like I said, in terms of year-on-year growth, I really think the best is behind us for the U.S. and also for other developed economies. Now, if you look at some of the high-frequency data that we economists have all turned to in this pandemic to see what's happening in closer to real time than our traditional economic indicators, they sort of tell the same story. So this is just open table bookings, restaurant bookings, and I've included the U.S., Germany, the United Kingdom. It's the same story across the board. You can see that we had a recovery in private dining bookings as the economies reopened, but ever since this summer, it's kind of gone sideways. And that, I think, is in large part thanks to the Delta variant, which is now receding. So we should see it start to tick up. But it's been going sideways. It hasn't continued to expand. The same is the case if you look at TSA boarding data. So how many people are traveling, and you can see there was a huge increase as we reopened the economy, but actually that's really ticked down since then. So growth is sort of turning over. It's still above potential, to be fair. So it's nothing to lament, but it's certainly not as strong as it has been. And this also goes for traditional economic data. And again, I included the U.S., but also the Eurozone and China here because it sort of tells a similar story. The U.S. is looking the best of the bunch, I would say, for developed economies at least. But anything above 50 for PMI data reflects an expansion. Anything under 50 reflects a contraction. So all these major regions are in expansionary territory, but less so than they have been. The latest month of data has been an uptick for the U.S. It surprised to the upside. But generally, we can see that peak PMI data is really behind us. So it's all telling the same story. Now, I don't think this is all down to the Delta variant. I think that explains some of the headwinds in terms of demand. But I also think, as I said at the beginning, that we're just in the long, hard slog part of this recovery. So it was always going to be much more difficult to get the last 30% of workers back in jobs than it was going to be to get the first 30% of workers. And so this is just a chart looking at the U.S. labor market, new jobs added every month. And you can see we're still, while the labor market has been recovering slowly, we're still about 4 million jobs behind where we would have been had we continued with the pre-pandemic trend. And so there's still a lot of ground to recover. A lot of that is because of sectors that are hourly services sectors, those sectors that got hit the hardest in the pandemic. So this is a chart just showing leisure and hospitality, restaurant and bar jobs. And you can see that they're recovering slowly, but we're still well below where we were before the pandemic hit. In his latest press conference, I think Jay Powell was really honest about the Fed's view of the labor market. He highlighted how much we actually just don't know about it because we've never been through this before. And so there are big questions about whether the labor force participation rate is just structurally lower now because a lot of people retired, they're just never coming back, or whether actually we can still try to run the economy hot and pull people in off the sidelines. And, your answer to that really matters for Fed policy because you need to know whether we have a tight labor market or not. And we're still not totally clear on that. But the Fed has sort of upgraded the labor market side of its mandate over inflation. The Fed's interested in inclusive employment now, and they take that really seriously, more seriously than before they revised their monetary policy strategy. So the labor market has recovered some, but is still pretty weak relative to where we were before the pandemic. Now, what does this all mean for inflation? There are two big camps, and I would say that inflation was both predictable and predicted, higher inflation, and that's partly because demand has surged as the economy has reopened. You can see that in this chart. It's the personal savings rate, and the first big peak is when we all shut down and stimulus checks were sent out. The second big peak also was when stimulus checks were sent out in the U.S. But we can see that people have been burning down their personal savings. It's now lower than it was before the pandemic, the savings rate. And so that just suggests that the demand has really surged. At the same time, as Janet highlighted, there have been real supply constraints. This is just a chart looking at PMI data again. So companies are asked about backlogs and deliveries, and you can see that backlogs and supplier delivery times have both increased. So again, anything over a 50 reflects an expansion. So companies are still suffering with long delivery times, increased backlogs, and that reflects the supply issues. This is also charts just reflecting the supply disruptions that the global economy, but particularly the U.S. economy, have faced recently. It's looking at the wave of imports that we have. So at the same time that there's been this surge in demand, we also have the Christmas season coming up. It's a bit of a perfect storm so that imports to the U.S. have really increased significantly all at the same time, and our infrastructure just hasn't managed to handle it. As a result of this, in part, the cost of freight shipping has also gone through the roof, and that often feeds through into final prices. So we knew we would have higher prices as the economy reopened. The question really is whether it's a structural change or it's just a blip. So economists sort of fall into two camps: team transitory, those economists who don't think that this will be sustained, and then those who are really worried about it. And those who are really worried about it include my boss, Larry Summers at Harvard, who's been arguing that actually we shut the economy down, we fell down a proverbial hole in economics terms. And the role of policy generally is to figure out how big that hole is and to fill it exactly with stimulus measures. And so if you look at the size of the hole that we fell down, so the output gap that we have, and you look at the size of the stimulus, this time around, and this chart is actually not including any of the things that are on the table for legislation, doesn't include the infrastructure package. We're overfilling the hole roughly 4 times over. And so for traditional economists, if you overfill the hole that much, you're going to run the economy hot. It will drive inflation higher structurally. And so these inflation hawks, their hair is on fire, just simply looking at the size of the output gap and the size of the stimulus being proposed. Now, there are others of us, and I would put myself in this camp, who are much less worried about this. And Janet and I will discuss this certainly in the Q&A. But, you know, they're also looking at some of the data and saying, look, there's some evidence that actually inflation was much higher, but it's actually starting to decelerate. So this is just month-on-month PCE inflation, which is, of course, the Fed's favorite metric. And you can see that month-on-month inflation has been decelerating for a couple of months now. And so maybe it won't be sustained. And again, Janet and I will get into that debate. Now, what will the Fed do about this? The Fed has come out on the side of believing that inflation will be transitory, though more recently, a number of Fed speakers, even just yesterday, there were 4 different Fed speakers talking about inflation. And for the most part, even the doves have come out and said, look, this has lasted a bit longer than we thought. The risks are that inflation will be higher than we expected. But we still believe this is transitory. The Fed has now announced that they'll start tapering their balance sheet this month. They'll start tapering by $15 billion a month for November and December. Then they have the option to kind of revise that from January onwards. If they carry on at that rate, they'll be done tapering in June of next year. And they've said that they'll finish tapering before they hike rates. So that means that, you know, in the second half of next year, the Fed could end up hiking rates. It all depends on the inflation outlook. And as I mentioned before, it also depends on your view of the labor market. So there are some indicators suggesting the labor market is really tight. There are others suggesting there's a lot of slack left. And so there's a big question about what has structurally changed in the labor market. Is the labor force participation rate just lower now, or is it possible for us to draw people in from the sidelines? That will as we get more data, I think that will inform the Fed's views on rate hikes. I think we may well get 1 rate hike towards the end of next year and subsequent rate hikes in 2023. This is just looking at the Fed Fund futures number of rate hikes by February 2023. On average, there's a probability that we'll have 2.2 hikes by 2023. So it suggests that based on this probability, it's right in line with my view. I have to say, I think it's going to be really difficult for the Fed to get rates up very high. A lot of us economists were very worried about corporate leverage before the pandemic hit. A lot of us thought that would spark the next downturn. Leveraged loans were a point of concern for a lot of economists. That has all just been massively turbocharged as a result of the Fed's stimulus measures in response to the pandemic. And so I do think that if the Fed were to hike rates aggressively, it could really undermine the financial stability part. That's an unofficial part of their mandate. And so I don't see the Fed getting rates up very high without sparking another downturn. I'll leave my comments there, but I wanted to first kind of kick it to Janet, because this inflation question, whether it's transitory or actually will be sustained, is kind of everything in financial markets at the moment. I think Janet and I probably spend most of our time trying to answer that question. And I've come out as a bleeding heart transitory person, but I'm curious where Janet falls on this.
Okay. Hi, Megan. And obviously, we've done this wrong way around. I was going to ask you about your transitory view. So I'm happy to go straight into my view. But did you want to go into more detail on your transitory, on your medium term first, or shall I?
You can go ahead.
I'll go ahead. Okay, maybe we can. I can't see the live view at the moment, so I'm not sure whether the slides are still showing. I'm sure our technical people can sort that out. I think You're absolutely right. It's absolutely the topic of conversation. It's what I spend all my time in my client meetings talking about. And, it's become almost a joke when people talk about transitory, because, we always used to have this view that transitory meant a certain length of time. But as Powell has made clear, it's just transitory rather than persistent. Are we going to be in a world of persistently higher inflation? So I don't think that we're on the verge of a rerun of the 1970s or the 1980s, nor do I think if we are in a world of higher inflation, it will be driven by the same factors that have been pushing inflation up over the course of the last 6 months. I think the fact that, used car prices and other supply disruptions have been, and now rental costs have been pushing up inflation. They won't be the same factors that drive inflation over the medium term. What I am a little bit more concerned about is not, the automation story. I'm a firm believer in automation. I still think that we are going to have areas of deflationary influences, increasingly in services, not just in goods, because of automation. What I am a bit more concerned about is some changes in political economy, about the broadening of central bank mandates and risk of policy conflicts, about carbon taxes, about central banks leaving it too late, arguably, as they wait to meet all of their goals, and some of the deglobalization related influences. Obviously, there were some strains pre-pandemic. And now I can't help fearing that with some areas of shortening supply chains, we may see a little bit more pricing power on a more lasting basis. So it doesn't mean I think that we're going to have, 5-6% inflation for the next 5 years. But I can envisage, I suppose, a deteriorating growth inflation trade-off. Maybe it's 1.5% growth and 2.5% inflation, rather than the other way around, which is what it's been over the course of the last decade. But Megan, you kind of touched on the fact that you're in team transitory. So are you a bit more of the deflationary camp?
Yeah, so I don't think anything has fundamentally structurally changed on the inflation front. I think a lot of people are worried that wages are rising because often then, when workers demand higher pay, companies will then pass that through to the end user and raise prices, which causes workers to demand higher pay. And it ends up becoming this wage price spiral. I think the great release valve on that this time around is actually productivity growth. So it's possible to have wage growth, and it won't be inflationary if you also have productivity growth. And if you look at survey data over the course of the pandemic, the vast majority of respondents companies end up reporting that they've used the opportunity of having the economy shut down to automate and digitalize. And so that should feed through into greater productivity. On top of that, borrowing costs are so incredibly low. Companies haven't been investing for the past 15 years much. And I think rates will remain fairly low for a long time. And so I think that will support investment and productivity growth going forward. So I think that's a great release valve. And it's kind of a Goldilocks scenario where you improve living standards for people without it being inflationary. I also think if you look at some of the structural drivers of lower inflation over the past 15 years, they include things like increased market concentration with superstar companies rising to the top, decreased worker power, digitalization, the gig economy. All of these things have kind of been turbocharged. The only thing that hasn't been turbocharged is globalization. And so if you believe that globalization is being unwound now, then that actually could be inflationary. I'm digging into this quite a lot right now, though, and I actually don't think there's really a whole lot of evidence that this has happened. It's a narrative we economists put out there at the beginning of the pandemic. Supply chains will regionalize. We'll see deglobalization. But actually, if you look at what companies are reporting in terms of their production, very few American companies who have plants in China are actually planning to leave in the next 3 years. And none of them are planning on bringing their activities back to the U.S. Some might come to Mexico. So we might see a slowdown in globalization, but I don't think we're actually seeing the massive regionalization of supply chains that I myself expected. And so I'm not as concerned about a deglobalization being an impetus for structurally higher inflation either. And also, if we have rising inequality, which most of us have managed, can really see off the back of this pandemic, that just exacerbates the global glut of savings. And so that I think just supports this idea that we're stuck in this low growth, low inflation, low rate world for quite a while structurally. I think the thing economists haven't been very honest about is how we define transitory. And I think we all have slightly different definitions. So I think prices will be higher for over a year from now. I think it's going to be until, Chinese New Year 2023 that we see some of these supply chain issues actually cleared up as demand finally recedes because of the Chinese New Year. And we managed to deal with some of the bottlenecks and deal with the backlog. So that's quite a long time for prices to be higher. I still consider that transitory. I'm curious, Janet, to hear your views on some of these supply chain issues. I know HSBC has recently done a survey on it, actually, but I'm curious whether you think this will last until 2023 or whether we'll see some resolution sooner.
Well, I think in the same way as a lot of the points you raised, I think there are going to be some big sector divergences. I mean, you made a very good point about productivity, and it's interesting. I've been looking at there's a lot of discussion now about Europe versus the US. The US has had this huge fiscal stimulus, and even if everything that President Biden is trying to push through, even if he succeeds, the fiscal support hitting the US in the next 2 years is going to be a lot less than hit it in 2020 and 2021. In Europe, they've got the next generation EU funds. There's going to be a lot more in the way of infrastructure spending, and particularly if they do the reforms, etc., that could be quite positive for European growth in the next couple of years. But what I find quite interesting is if you look at business investment, which is obviously where a lot of the dynamism comes from in the economy, rather than the public sector, US investment spending has held up remarkably well. Investment in machinery and equipment, and particularly in IT and software-related investment. And that leaves me feeling quite positive about the productivity outlook in the US coming out of the pandemic. You're absolutely right. I think it's been investment poor over the last decade in much of the world. It's been a very job-rich recovery since the financial crisis, and investment poor. It could be, if we're in a world where labour's become more expensive, that we see more in the way of investment and in the way of automation. And I think that's important, but I think it might be in different sectors. I think for a lot of the last decade, a lot of the productivity gains and the improvements were in the goods-producing part of the economy. It was all about cross-border efficiencies in the production of goods, really highly integrated supply chains globally. I think there is going to be a deglobalization of supply chains. I think there's some evidence of it already. We certainly saw it in medical equipment and PPE. I think we're even seeing it in areas of chip production. The US wants the Koreans and the Taiwanese to make chips in America as well. But where I might be a bit more optimistic actually is the productivity benefits from automation on service sector, with people working remotely. Who knows where they're working, what country? So I think that element of productivity could be actually a lot stronger. What it means for the aggregate economy and for financial markets could be very much about these different sector stories. It's not so much what's happening to GDP, but you're part of GDP and how quickly that is growing. And I think the inflation side of it is really difficult to forecast. I agree with you, wage growth is extremely important. We've been surprised, certainly, about the lack of labour market participation. Obviously, everyone's going to be watching the labour market data over the coming months to see any signs of participation rising. Our forecasts still assume that it does rise back, that it will have to, and that the demand will be met. But the labour market picture, I think, is highly uncertain, and the other political economy developments that I mentioned just make me a little bit nervous about this deteriorating trade-off beyond 2022. Not a big inflation problem, but just slightly higher inflation. But agree with you, it's a lower growth world. I'm more worried about what slightly higher inflation means for growth rather than a big wage price spiral indefinitely.
Yeah, I might mention just in the few minutes we have left before we go to the Q&A, and I hope everybody's submitting their questions, that in the interest of being intellectually honest, the big weakness in my argument for weaker inflation over the medium to longer term is the green transition, actually. So if we were actually able to succeed in hitting our net zero targets, that would produce a pretty significant negative supply side shock on the economy. And I think prices would go up pretty significantly. And of course, it depends entirely on the speed of the transition, whether it's front loaded or not. But there is an argument to be made that the supply side shock that we experience as a global economy is on par with what we experienced in the 1970s. So I generally don't like these comparisons between now and the 1970s, but this is one that I think actually might hold, where it's just the magnitude of the shock. On the other hand, I don't actually think that we're going to manage to make that transition and hit our targets. I hope we do, but I do also think that it's worth being upfront about higher costs everyone's going to face. And of course, Janet, you're sitting in London or in Europe. Europe is experiencing much higher energy costs right now. That will inevitably feed through into higher costs for goods production. And so we're just starting to see the beginning of this, but I think we'll continue to as we.
Megan, you wrote a very interesting column in the FT on this last week that governments need to be honest, as you said in that column about the costs involved. But does that mean you don't expect them to be honest? They just won't deliver?
No, I think governments mostly want to highlight the opportunities from the climate transition, and there's no doubt there are. So I'm not suggesting that these costs mean we shouldn't do it. It's just not part of the sales pitch, and I think it should be, because otherwise we'll get the kind of backlash we're seeing in Europe right now, where people are starting to say maybe we're making this transition too quick. Maybe we should still rely on fossil fuels. And we just don't have time for that kind of backlash, given the magnitude of the transition we need to make pretty quickly. So that's my concern. In any case, I think it is time for Q&A. So let's turn it over to David, who's been collating your questions.
So maybe the first question, and as it's been a very enlightening discussion that you've had, Megan and Janet, but I think how correlated, I think one of the questions that's come in is how correlated is the U.S. and non-U.S. economies and approach to where we are today, from a Federal Reserve perspective versus other central banks, from a stimulus perspective versus other governments. Is Brexit still a thing? Does that matter? I mean, should we be looking more, let's say, local, or are we still in a world where a global perspective is the way to think about things? In particular, as we're thinking in the context of this conference, private investments and those kind of emerging companies.
So I can take a stab at that. First, I think we're starting to see a divergence in approach, even just among developed economies, in terms of fiscal and monetary policy. So, the UK was always going to be the first country, I think, to start withdrawing some of the fiscal stimulus. You had the Chancellor of the Exchequer making jokes about taking away the Prime Minister's credit card very early on in this pandemic, when no one should have been talking about austerity or retrenchment at all. So the UK has sort of led the front on fiscal hawkery, I think. It's the Bank of Canada that's led for developed economies in terms of monetary policy and withdrawing accommodation there. Both the Fed and the Bank of England have, the Bank of England seems closer to hiking rates, certainly, than the Fed does, but both have actually recently suggested maybe we should wait a little bit. It won't be as long for the Bank of England as it will be for the Fed, I don't think. And then if you look at the ECB, I agree with Janet. They're still hitting, their foot is on the gas in terms of both fiscal stimulus and also monetary stimulus. I don't think the ECB is going to be talking about hiking rates anytime soon, not for the foreseeable future. And you've got what one Italian policymaker described to me as money from heaven raining down on Europe from Brussels in the form of grants and also loans. And so I think the policy stance is much more accommodative still in Europe than it is in much of the developed world. And the U.S. has fiscal stimulus coming through. We'll see exactly what's in it. But it looks like the Fed is starting, while they still think inflation will be transitory, they're starting to pull back in terms of purchases and are looking towards when they might start hiking rates. So different countries, I think, are applying different stances now for the first time since the beginning of the pandemic, really.
And if I can just add to that, I think actually within the advanced economies, it started with Norway and New Zealand. And that's partly a function of central bank mandates. They're both central banks. Well, Norway never did QE, and they have an enormous sovereign wealth fund, and they have financial stability as part of their mandate. New Zealand also has financial stability. So for some central banks, they do take the approach, a stitch in time saves nine. They'd rather take the risk of slowing the economy too much and preventing a financial crisis 2 to 3 years down the road. There are other central banks where, especially if they're at the zero or negative bound, they know that if they get it wrong, they've got no policy ammunition left. And we also know that for the Fed and the ECB, because they're the two most important central banks, it has much bigger implications for the world. But you mentioned, David, does Brexit even matter? And actually, I think it does. I think it does matter, both for the potential growth rate of the economy. And actually, for the Bank of England, when they met last week and, they shocked markets. They didn't shock economists, but markets were furious with the Bank of England. It didn't raise rates. And, why didn't it tell them it wasn't going to raise rates? And one of the things they did in that monetary policy report was talk about the medium-term impact on supply. When a central bank sets policy, it's for how it will impact on the economy 2 to 3 years down the road. So they're really thinking, what is the lasting damage to the economy from COVID, but in the Bank of England's term, from Brexit itself? Has this permanently lowered the potential growth rate for the economy, and therefore for their estimate of the amount of slack in the economy, particularly now that we're not going to have free movement in terms of immigration. So yeah, Brexit matters for growth, and it matters for the policy setting. And yeah, the Bank of England will be raising rates. We think February. We've always thought February, but December will be a close call. It will be the first to go down the fiscal consolidation route. And that's why it won't get very far. We've got 3 rate rises from the Bank of England in our profile, but then they're brought to a halt because fiscal consolidation will be biting.
So in our last 3 minutes, I'll ask a question that maybe takes 3 hours to answer. But as we see more and more, let's say, emphasis on cryptocurrencies, as we see China banning them, are they being disingenuous? Do they really want the price to go down so they can buy? Will that be a factor going forward? Will the dollar continue to have the status it has in the future? Or how do we kind of see digital, crypto, dollar, various countries banning, encouraging? Where does that play itself out? And I realize we've got 2 to 3 minutes to answer that.
Yeah, I think I'll take a stab. I think that most cryptocurrencies are very effective securities, but actually not great as actual currencies. But they have prompted a lot of central banks to look into generating a central bank digital currency. So, to use a technical term, I think the rise of crypto has scared the bejesus out of central banks, who are worried that all of this activity will move into private hands, and the central bank won't be able to manage it. So I think, probably the biggest impact that cryptocurrencies will have had isn't as currencies themselves. It's in the technology behind it. So blockchain, I think, will revolutionize a number of industries, that technology. But also, I think it will massively accelerate the introduction of central bank digital currencies, and that will have real implications for banks. I think most people will prefer to hold a central bank digital currency than a bank deposit. And so the traditional business model of banks taking their deposits, leveraging them up, lending them, and taking the yield, that won't really work if they don't have as many deposits. And so I think it will certainly create challenges and disruption in financial services. But I don't think cryptocurrencies are very effective currencies themselves.
And the US remains reserve currency.
Yeah, that's right. I don't see King Dollar being dethroned in our lifetimes for sure.
So maybe a final comment from each of you, and again, very insightful today. Where do you see the overall economy, let's say at the end of 2022? So just a year out, will the transitory inflation be passed? Will the stock market still be at all-time highs? Where will we be?
So I think we'll still be experiencing higher inflation. I don't think it's until 2023 that really abates. So inflation will be higher than the Fed's mandate for sure. Growth will be well above potential, which is 2% roughly, maybe a bit lower. And so we'll still be in the long, hard slog part of the recovery, but growth will be outperforming certainly. So I think we'll see that dynamic, which, isn't the stagflationary scenario that a lot of economists are really fretting about.
US inflation is going to hit 6% on our forecast in the next month or two. I think it will be lower than that at the end of 2022. But like Megan, I think it will still be above the Fed's mandate. I think they'll have to revise up their inflation forecast, but I think they'll talk their way through that. And I think that growth will, we're seeing a revival in growth at the moment. It will still be volatile. But as we go into 2023, I think we will be getting closer to that kind of 2% kind of level in terms of the US outlook. Equity markets, asset prices, I'm not the strategist, I'm afraid, but I think there'll still be a fair bit of liquidity out there.
So, we're at the end of our time. Janet, Megan, thank you very much for joining us today. We very much appreciate your insights and your comments. For our audience, thank you for being with us. And you can go back through the platform to click to the next session, which is Lauren Dillard from NASDAQ. We'll be talking a little bit more in depth on public markets and the intersection with private markets. So again, thank you for your participation, and we look forward to seeing you in the next session. Again, go back through your platform to click on the link to that session. Thank you very much.